Yo, 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 yo. Good afternoon, folks. It is currently 1 o'clock, 1 p.m. for me. We have watched like the next 4 episodes, but we haven't taken sufficient notes. So we're going to go through them again, this time making notes. I was going to just kind of speed run through them like I did in the past 2 live streams where I just listened to it. But I think it's more beneficial if we actively take notes, despite whether we know it, how much we know, how much we think we don't need, etc., etc. I think it's important that we just continue with the habits of taking notes. With that being said, we finished episode 20. We are now on episode 19. Sorry, we're now on episode 20. This is where everything will be very nice in terms of speed. We have 1, 2, 3, 4, 5, 6, 7 long ones remaining. They're all less than an hour, so should be able to fly through these in the next 6 days, which is our limit before we start trading live on May 8th, which is in 1 week's time today. So that's next week, Friday, end of the week, Friday. So that week from next week, including today, we'll be turning what we know into live trading. So everything we've learned, we'll begin to put it into practice. And we've done some markup on ADCAD, and that is going to contribute to the ideas we have. Okay, so we're going to go through some of these as well over the course of next week and see where we're at. Okay, we'll come back to that later. Right, so in the meantime, we're going to do this. This should take like 5 minutes.
The algorithm will likely, not every single instance, but it will likely repeat. Okay, it's the logic that I've shared on this YouTube channel. And I've been asked, obviously, if you read the comments in the videos, can I show an example of this working in London session for Forex? No problem. To do that, I set the stage with the analysis last night. There are folks out there that will say, I don't know how to pick the tops and the bottoms or the highs and the lows of the day. They don't know what I'm teaching, so it's easy for them to say those types of things. And a new student may stumble upon their comment, may stumble upon their YouTube channel, and whatever their medium is, they follow that logic without investigating it or looking into whether or not these things that I claim are true. So without a safety net last night, I outlined it for you. I explained what it should do, why it should take place, and therefore we watch. And do I see in my chart, like you should see in yours, what I outlined? Not exactly to the level I was outlining, but the general premise was there. What do I mean by that? Well, we were in this area here, and I mentioned that I felt that it was going to go below the 100 level. And if I were making the market, in other words, if I was the market maker, providing the parameters at which the dollar index will go down to set up a buying opportunity, I would take it down to the 99.92 level. Okay, and you can check me on that with the video I uploaded, and I can't edit a video on YouTube. Once it's there, it's there. Okay, so I know some of you are actually downloading them. That's fine. But go to episode 19, which is the one I just did last night, and listen to the 20-minute mark around 10-second in that vicinity, and let it play for a minute or so. And you'll hear me outline the very thing that you're seeing in your chart right now. So the question is going to be, how did I know to call that level? And why did I know that it was likely to set up a London setup? Well, I'm going to teach that to you tonight. So understand, this is not the model for my daughter. This is not in addition to the model. I'm just simply answering questions because I got a lot of them, and I'm not trying to push this inside of the model for this YouTube mentorship, because the next step is going to be, can you go into London and do live sessions so we can copy what you're doing? I'm not going to do that. Okay, now some of you are going to be upset, say, oh well, see, you're not proving anything. Well, if you're not seeing this as proof, move along. Okay, just move along. I'm only going to do what I'm willing to do. Okay, and I'm having fun showing what I'm showing, and it's really enough. Only those individuals that want to be spoon-fed setups and trades and piggyback my ideas, they're the only ones that really push and twist my arm, and they're going to be frustrated. So I'm just letting you know, That's not going to happen. So don't ask. I don't care how many times you present it nicely in a comment or request. It's simply not going to happen. It's important for you to go in and find these setups on your own, do what I'm teaching. So I mentioned that we would drop below that 100 level. Why did I pick the 99.92 level? Okay, well, if you look at the price action right over here, okay, we had this run up at the beginning of that candle right there. Just draw that out in time. I gave you about 99.95, this run up at the beginning of that candle right there. Just draw that out in time. I gave you about 99.95, 99.92 level. Okay, a small little range of about 3 pips. That's what I was eyeballing last night. Now, I was talking to you, obviously, before midnight. Now, there's things that I teach and have in my repertoire that helps me fine-tune the low of the day, and I'm not going to teach that here, and because I have a community, obviously, I'm obligated to. I'm not obligated here, okay? So I don't want you thinking you can guilt me into doing more than I'm already willing to do, but just know that there's things that I can basically use in my repertoire at midnight that will help you fine-tune the actual low within about 2 to 3 pips. Sometimes right on the very low, but it's not needed, okay? The idea that I just gave on the fly last night when I was doing the commentary was really simply just rooted on the idea of this extension and ending it right on that candle's high, and just eyeballing it. So that's what I was looking at. I expected it to drop down. I'm not convinced that we're going to see this top yet. So I felt that it dropped down here. And also, being a setup going into London, that's what I would expect. And I'm going to teach you how to use that information if that's what you want to investigate and study on your own. But notice that we ran above these relatively equal highs, and that's what we ran for the intraday price action target. So the high of the day that was set initially around the midnight time frame, it dropped down, creating the entire run lower, creating the London low real close to where I was outlining. Not exactly, obviously, but it's good enough for government work. And the market starts to rally and it takes out the initial high of the day. But more specifically, it aims for these really clean levels. You have this high here, here, and here. Remember I was teaching? Just like this level here, the market does not like to leave that. That is not efficient. Now, it's efficient for technical analysis, Retail 101, where they'll see that as resistance. It looks perfect. That's what they want because the books teach that. The books are meant to trip you up. It's flawed logic, folks. I mean, I hate to say this type of thing to certain individuals because they take aim at me like I'm trying to belittle everyone else. It's not that I'm trying to belittle anyone else. I'm trying to shake you by the lapels and simply say, look, listen to what I'm saying. Don't believe what I'm saying. Investigate the things I'm stating in the videos. That way, you can come to your own conclusion. Either I'm making things up or there's really logic behind it. And you can dismiss 99.9% of the things out there that everyone looks and relies on having their charts as far as analysis concepts or indicators. You don't need all that stuff. So if I'm suggesting, as I mentioned last night in the video, that we would drop down here and then start to go higher, that sets the stage for what? If this is going to be a point at which it reacts and goes higher, as I was outlining around this time period in the video, that means the opposite should be seen for Euro. But before we get into that, let's fine-tune this a little bit more on the 15-minute time frame. You can see we drop down creating the low of the day in London Open. That's our kill zone that I teach here on the YouTube channel. It's 2 o'clock in the morning to 5 o'clock in the morning, New York local time. So if you are using the time window thing over here, set it to local New York time, 2 o'clock to 5 o'clock in the morning, that's the kill zone for London Open. Market comes down, creates the low of the day, runs back up, back into an order block here. I'll let you look at the lower time frames, and you'll see that is in fact an order block. And optimal trade entry, and the market starts to create its run up into the relative equal highs, sweeping that as a daily objective. Now, if this is the low of the day, and if it's what I've outlined in advance, and you see that last night beforehand, this is what I expected to see price drop down in and then start to go higher. At the same time, Euro runs all the way back up to the previous week's high. How is this likely to be a false breakout? We have to use intermarket relationships like I'm showing with dollar index. So if you're trading Forex, it's important to relate your analysis in the trading market. Okay, for instance, if you're looking at Euro, that's your trading market. You have to have a barometer, something to measure its movement with, and that's intermarket relationships. So having that with the dollar coming down to the level I outlined last night, that would be a bullish area. It'd be a sensitive price point to see an advance higher. Because its relationship with Euro, it's inverted. So if the dollar is going down to that level being 99.92, then it's not a surprise to see Euro rally higher as it's doing that. But what is the Euro reaching for? This high, and then went so far as to go up above the previous week's high. So they really reached up in there, took out the previous week's high, and at that same instance, right there, that's when dollar hit the objective I told you last night. That would be a buying opportunity for dollar. If it's a buying opportunity for dollar, then it's a shorting opportunity at that very moment. Look at your own charts and study the moment it hits this level here. It's the same moment that the dollar index is hitting that area I was outlining last night for a buying opportunity for dollar. So this is a false breakout because my analysis was done and shared with you openly that would be a buying opportunity for dollar, setting the stage for what? As I outlined, I'm bearish foreign currency. Could I have bought that? Sure, because I'm expecting the dollar index to drop down to that 99.92. Did I? No. I went to sleep. I was tired. So I'm not concerned about that. I didn't take the short either. I don't care. I don't want to be in every single move, and I'm not trying to trade Forex right now. But to prove to you folks that are sitting out there asking to see if it can be done in London, does the concepts work? Can I call a move? Can I give an idea? Can I do these things before it happens? Yes. But simply because I can doesn't obligate me to. Okay, I'm not here trying to perform magic tricks for you. Okay, I'm not trying to do that. I'm trying to teach you to trust your own analysis and lean on your own experience, even in the early stages when there isn't that much of it. It's okay. You learn to grow gradually. All right, so the 15-minute time frame, you see that the Euro went up into its kill zone here, 2 o'clock in the morning, 5 o'clock in the morning, New York local time. So it creates the high of the day. So in this price run, we're going to start stripping it down. I'm going to make it very easy and not make this video very long. I'm going to jump right to a very small time frame chart. 2 minute has the very clean fair value gap. So after it ran above that old weekly high, the market trades lower and takes out that short-term low. Now, some of you might see this short-term low and say, well, why do you use that low instead of this one here? Well, the reason why is the fair value gap forms right here on this candle. Once that candle closes, the very next candle, it opens essentially right at that low. So it hasn't really moved away and hasn't really shown me what? Displacement. Something energetic where it moves away from that fair value gap. That's the important factor. So we have the fair value gap here, and then it moves lower than that short-term low. Now we have a shift in market structure. The market could have came back up into this run here and offered an entry every day. Just that. It went a little bit lower, that's fine, and then rise up to that level here. This is the entry point. Now, think about where your stop loss will be, and think about where your entry will be based on what I taught you using.
Wait, so he's saying he didn't use this low because we didn't displace. Yeah. I think I see it. Let me see how he worded it.
It opens essentially right at that low. So it hasn't really moved away. We're going to start stripping it down. I'm going to make it very easy and not make this video very long. I'm going to jump right to a very small time frame chart. 2 minute has the very clean fair value gap. So after it ran above that old weekly high, the market trades lower and takes out that short-term low. Now, some of you might see this short-term low and say, well, why did you use that low instead of this one here? Well, the reason why is the fair value gap forms right here on this candle. Once that candle closes, the very next candle, it opens essentially right at that low. So it hasn't really moved away and it hasn't really shown me what displacement, something energetic where it moves away from that fair value gap. That's the important factor. So we have the fair value gap here, and then it moves lower than that short-term low. Now we have a shift in market structure. The market could have came back up into this run here and offered an entry. It didn't. Notice that. Went a little bit lower. That's fine. And then rise up to that level here. This is the entry point. Now, think about where your stop loss would be and think about where your entry would be based on what I taught you using the New York session.
So I am cooking something I need to go check. So in the meantime, you can see here that we, oh wait, what said entry and stop loss. Okay, so entry would be at the minimum here. And then our stop loss would be right above this black candle here. You can have it above here if you want, but I would probably put it just about this blue line. So from here to here, entry, stop loss, entry right here, stop loss right here, entry, stop loss.
This is an opportunity to pause the video and think about your frustrated annotations. You're smirking out. You think, I'm not pausing. So you just might as well get on with the ICT. Okay. So here we have a zoomed in 2 minute chart. And here is the fair value gap level that you would be putting your limit order in. So it's still essentially right there. Remember, it's not going to be placed in the marketplace for a shorting opportunity or entry on limit anytime in here because it has to move away from the fair value gap. So it does on this candle here. So we have that run through this short-term low. We have displacement. There's energetic move lower away from the fair value gap. It doesn't get to it here. It goes a little bit deeper. We wait. We don't chase it. We don't go in there thinking, oh, well, I missed the move. We still have time. See all this over here? The kill zone for London Open is still open. So we allow for that retracement higher. Your fill here, maybe 1 pip at, maybe a half a pip, or maybe a full pip above this candle's high. That would be your entry, but we're just going to use the actual candle high. That would be your limit order entry, hypothetically, 1.0924.
So give me a second. I'm boiling eggs. Okay. Let's continue.
Look at that. That's your entry. Your stop loss will be above the high here. That comes in at 1.0936 and a half. And the heat or the drawdown that you absorb, hypothetically, if you would use that entry point, is 1.09301. So basically, not even 5 pips. Okay, so, well, about 5 pips, around about 5 pips of drawdown. So essentially 25, we'll call it the 30. So call it 5 pips, there it is done. So 5 pips of drawdown, and never came to your stop. With this gearing, okay, if you use sound money management, how much can you risk if you're risking $1,000 per trade? Okay, you're thinking about money-wise, don't do that. You think about it in terms of fixed percentage risk on equity. So that means you're simply going to look at how much money you have in the account, take that, times that by 1%. Okay, 1% is the maximum. Preferably, you should be doing a half of 1% or maybe a quarter of 1%. You're learning. You're not trying to do a lot in the beginning. You're trying to just simply trust the idea of seeing these moves. None of you should be going into the demo. None of you would have done this, obviously, because we're talking about hindsight. But I'm showing you the relationships of how when the market went to this level here and created buy stops on the previous high on euro, that's the very moment that the dollar index went down to the level I outlined. It would be bullish. So the teeter-totter effect or the inverse relationships, that if the dollar's going to go higher, that means that it's going to have weight introduced to euro and it should start to go lower. So your entry here and your drawdown and your stop, all those being what they are here, we go out a little bit further, and I'm just using a 5-minute chart so I can put everything in the fractal. In other words, the fractal is this move up and then down. That way you can see it all and have the candles still be clean and have everything on one chart. So that's the only reason why I'm showing the 5-minute chart. It's not that I'm doing anything special with it. Okay? It's just to show you the overall dynamic of this price run up, the rejection, the optimal trade entry that would be used with the fair value that used on the 2-minute time frame, all the levels and things here being as they were on the 2-minute chart. And if you did a Fibonacci run from the low here, why this one because it was most energetic starting this price run here, that would be your parent price leg. 50% is around in here, so that would be a nice objective initially of your first target. If you're going to hold for the full day, it could go down to this area here, and lo and behold, we have that imbalance. You trade right into that rather handsomely. So there's your example using it. I gave you the framework beforehand. I told you what to expect in the dollar index, and everybody should know that the euro is going to be the opposite direction of whatever the dollar's going to do. So hopefully this has been insightful to you. You got something out of it. So I'll talk to you next time, next week, next Tuesday actually. Lord willing. Enjoy your weekend and be safe.
Well, yeah, I mean, he gave us one example, basically showed us the strategy again. The only thing I added was that that's why we use it with this low instead of this low as the market to shift confirmation. But the main work he did was within the predicting the daily bias of the daily time frame of the DXY index pair. So the dollar index, and then he's showing relations. All this I already know. I could have maybe detailed a little bit more on what he talked about in terms of the DXY index. That's mainly like the previous episode anyway. So for episode 20 itself, I think I'm happy with that. So now we can move on to episode 21. Halfway there. More than halfway, actually.
All right, folks, welcome back. This is our 21st episode of the 2022 free ICT YouTube mentorship. Little tongue twister there. So we're looking at the hourly chart on the dollar index. Why are we here? Why are we looking at this? Well, I'm looking at this because I want to show you the relationships between a risk on and risk off market. If you've been following along in the comment section, and if you haven't paid attention or even noticed, all my videos in this mentorship, the comment section is open. Okay, so you're welcome to make your appreciation known. You're welcome to, prompt me with specific questions that you want to see me kind of like touch on without making too much of a long-winded request for it. I can kind of get a feel for what you're looking for, and I'll work those ideas into the lesson so we can hopefully get everybody's understanding on the same page. I may not respond to your post. I may not, directly answer you. Sometimes if it's short and easy, I'll do that, but if it's a question I see a lot of across the other videos as well, I use the videos to kind of like answer it. So it's important you take notes because usually you'll find that the questions you have are answered in the progression through this mentorship if you're coming here later than 2022. All right, so one of the questions I got, and I get this a lot for people that have not been trained by me, the idea of using the dollar index, is it useful like when I look at the Forex market, like if the dollar's going higher, obviously that's going to put pressure on the foreign currencies, and it'll be less likely for them to have sustained rallies. They're more likely to have sustained declines. So dollar up, foreign currency down. Dollar down, foreign currency up. The reason why that's occurring is it's a risk on, risk off scenario. Dollar, if it is going up as we have here, this is a risk off scenario. Okay, risk off scenario implies that generally every other market or asset class will start to decline. And this is treated as like a flight to quality, okay, or a safe haven. So money pours into the dollar and it pours out of risk assets. That would be like foreign currency. That's why I've been telling you to look at the euro dollar go lower and make a new low on the daily chart. And today it did. I know it's random. And then also this applies as well to the stock market and index market. So obviously I'm kind of like pushing the index futures in this mentorship on YouTube, but it's applicable. Obviously, everything I'm teaching here is universal, so it works in everything. Now, I'm not co-signing crypto. As a reminder, I do not trade cryptocurrency. I have absolutely zero experience trading cryptocurrency outside of a demo account or a paper trading account. I've never done anything with it. I've never opened up a crypto account. I have no interest in ever going into the asset class, and there it is. Okay, I see a lot of you asking that in the comment section, so I'm going to try to throw this out there every now and then as a reminder because I don't do anything with an asset class. I have a lot of students that trade them, and they swear by my concepts working there, but I personally don't do it. Okay, so there's that. I'm a Forex and futures trader, so that way you guys can know what my specialty is, and I want to show you this chart here and remind you of what I mentioned in the previous week in our meetings together in the episodes. I said that we would likely see the dollar index drop down. If I was making the market for the dollar, I would see it go down to around 99.92, and go back and listen to the videos, and obviously you'll see it, it's there and hear it. And then I said I would run the relative equal highs and start to run it higher. I gave you the objectives of relative equal highs and mentioned like 1 and 2, 1 and 3, and even my private mentorship group knows those objectives as well. And we have it here. Okay, so I'll leave it up to you whether or not you find this inspiring or not, knowing that this was likely to occur for a London setup and then rally higher. I want you to look at the relationship between this price move here and go back in the commentary where I was referring to that daily bearish order block on the index futures. Okay, so I was talking about the low of the daily order block, the open of the order block, and the mean threshold halfway, and then the high of the order block being the less likely level to be traded to. And I'll talk about that when we get into the E-mini S&P portion of this episode. But for now, let's take a look at what the relationship looks like with the dollar versus the E-mini S&P. So this is the June contract for 2022 of the E-mini S&P futures market. And you can see as the dollar creates its important low that I called publicly, you guys know it, I've said it, I've explained it to you in detail. As this dollar was going higher, what was going on in the E-mini S&P? See that inverted relationship there? That's why if you go back and listen to the recording, when I was talking about that bearish order block on the E-mini S&P, I said that we're going into May, and it's usually a seasonal decline. And I'm going to be looking for signatures to warrant downward pressure in this particular asset class and recompose relative equal lows on the daily chart. Hello, look at your chart, folks. This is what it's like to be mentored. This is what it's like to know what's likely to occur with tools that make sense. There's nothing ambiguous here. There's nothing, splattered across the chart. It's just simple, sound logic. Okay, I'm hopefully inspiring you to simplify, which many on the outside looking at what I do will make snide remarks like, "Oh, he overcomplicates things," and I'm not complicating anything. These are very simple ideas, and it helps you build the idea of bias. It gives you intermarket relationships and intermarket analysis to give you the trust. Okay, why did I feel confident to publicly say that 99.92 level? Well, I explained that. Why did I think it was going to rally from there? Because I'm bullish on dollar. Why did I hint that we're going to be going lower into the E-mini S&P relative equal lows and as we enter into May? That's a seasonal tendency. So all those factors came together. In my experience of almost 30 years, was used to hint at something for you to study. And if I'm right or if I'm wrong, you get to be a judge. Okay, you get to see and weigh me in the balances. I've laid it out there in your hands. You see right now in this chart what I was forecasting, the reasons why I was doing it, why I said what I said, and why it looks like it does in your chart today. All right, so here's that daily chart, and here's that bearish order block.
Okay, so he said something important, which we're going to rewind to, which was some of the factors we wrote in around about episode 1, I think, which is direction. And he determines direction and simplifies it to what? Is the next candle likely to go up or lower? Not where will it close. It's just higher or lower. Right? Then he goes into his reasonings that it's the seasons, such as summer, winter. Obviously, you have the general seasons, but those are quarters, and those quarters tend to, or halves, like the first half of the year, the end of the year, the second half of the year, the last quarter, the last 2 quarters, or this or the third. These different terminologies they used to describe the general flow of where price or the instrument behaves. So it's a behavior analyst or analyst. It's a behavior. Well, it's basically us analyzing the behavior of a price. Then we can get the underlying tone, which we get more so from the daily, as that is where most institutions trade from, and they target imbalances and liquidity on that time frame. So by reading where liquidity is, by reading where imbalances are, we can definitely utilize that to discuss or discern where price is going, at least for the next daily candle. And there's this, and we need to see it as a magnet. Okay, so before I go back into that mentorship, it's currently almost 1:30, and I want to start seeing the opens and start looking at them. So we are bullish on this. Why did we say the next candlestick will be bullish? Well, we have this range, this swing low, this swing high. So we drew the range. This is equilibrium. Price has broken market structure to the upside, created some imbalances as well. Price then came up to this level here, swept this liquidity over here of these highs. Then it came back down to this equilibrium level. Whenever we touch the equilibrium, we are bullish on the next candle. And we touched it here. We didn't quite touch it here, but we touched it here. And guess what? We were bullish next. So manipulation, accumulation, distribution. And we believe that though we are in a premium, we are following up from this idea of the fact we just come from discount. Generally speaking, when I'm at discount, I expect a concession or continuation of candles. Like 1, 2, 3 candles up. So 1, 2 could even have a continuation. Also, we swept liquidity down here. So there's lows, 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 lows. This candlestick took out all of this liquidity here for buys. which fuels this idea upwards. Market structure shift, pull back into discount area, liquidity sell side taken, and bullish. So we drew midnight open, which is down here. We had a rally down here, which is probably the Judas swing. And then we have a huge displacement manipulation upwards, some consolidation, equal lows over here, and then a push to the upside. We are now trading opened here. That's the session open. Get around by here. But we're bullish. Just having some noodles. Okay. Right. So we've gotten the bias. Now it's about entries, right? So we need some sell side liquidity to be taken. After we have sell side taken, we then look for market shift to the upside, and then a retracement back into the fair value gap within the displacement range to then buy to our buy side liquidity. So speaking of buy side liquidity, if we go to the hourly time frame, well, let's go daily first. We have some liquidity up here. Just fairly close to where we're at. I like that. We also have fair value gap here, which price. I'm gonna keep liquidity instead. Like that as a target. We do have like a continuation. This seems like this was the like this is the sell side liquidity that we took right here. Can get rid of these vertical lines. So we took sell side liquidity here. You can see with this. Actually, I kind of like the vertical lines. So you see by this midnight session here, we swept this liquidity over here, displaced upwards. We didn't come back down into this level, except came back down to the edge of it multiple times. But we never really delved deeper. But we were not entering this. To be fair, we could have in London kill zone, but we didn't. Currently, we have market open here, so we've had the manipulation already. We are mid distribution. So because of mid distribution, we then look to what time frame is that fair value gap? So this one's hourly. thing about this is that this one has been filled, and this one also pertains to order block. So I'll mark this line right here. Like this idea right here. I think I have an account somewhere. Let me see if I can find it. Don't know what is in it or if there's even in. Oh, there's actually a decent amount of money. All right. Set the limit. Let's see. Euro. What? So I need to post this because I was meant to finish today. We're only on episode 20 still. I'll post that just before I post this idea because they may not know why I'm posting early if I don't tell them why. So that's why I said a message. Basically, if I scroll up, I said here that we will probably be doing finishing May 1st. Now, that was on the premise that we will be watching one a day, maybe two, right? And we were on episode 5 when we said that. We're now on episode 20, which is a long way away, which is good. We made progress, but it is not where we are, unfortunately. So from then, I'll expect to continue posting trades again with maybe a week window. So May 8th. And truly from then, I don't see me dropping off again for the rest of the year. So basically, it's like the base model of which we have changed completely our understanding of the markets. We used to be a retail trader, and in the sense that we thought like one, and we're now changing our thinking towards that of an institutional trader. and was a struggle because how do I know what institutions think like? And there needs to be data backed information. There needs to be experience. There needs to be clear ideas. There needs to be a full program explaining such. And there was many people that had boot camps, or mentorship playlist or whatever you want to call it. But they lacked, you can hear it. And what I would say is, as a retail trader, once I've listened to so many different people talk, you then begin to learn who's lying and who's not. So I had to develop myself to even have the ears and mindset to then depict who's lying and who's telling the truth. So that was the start. Then once I found ICT through heavy research, and then obviously the research wasn't just watching the videos, it was more so why are they mentorship? Why are they doing mentorship? What is their track record? What is their students' reports? What's the review on them? And when those things check out, it's like a background check. It makes you more confident to start listening to that person. And as you begin to listen more and more and more, the idea of what they're saying begins to get clearer and clearer and clearer. So this is us. I think this idea is potentially about to start working. So this is EU idea. I'm gonna utilize my journal. It's been a while. I haven't worked on this in a while, I'll be real. And we are going to open a small account. You don't know how much is in this. Open a small account, and then I'm gonna call it new model test. Well, let's be more specific. Can I edit it? Let's say go to this. Right. So this first picture. It is Euro USD. Is long. This is the New York Open. Is this? Actually, well, let's paste this first. Actually, picture here. Grab this. Scan the screenshot. Yo. So much is in the account. This is stupid. I need to fix that. I'm actually willing to get rid of that whole account. So let's make sure we don't miss the entry. They're closing down. Was that something else? We are risking about 10 bips. How much do we risk? Maybe about £5. So I think I was sneezing, so. Right. So we've entered all of that. We've done the 15-minute time frame. I did the daily in as well. Up into the my draft. The draft. Hello? Just didn't want to work. Interesting. Let me get my button ready so I can just literally tap it. Stop loss 117453. Loss, take profit where 179. Doom, happy with that. Okay, I'm ready to just press the button and I'm in the market. Let's rescan this. Don't know why it's doing that. Click apply, apply. New York, yep, correct model. All this is good. Well, got anything yet? Is it? Know exactly when. You can actually get in now because it's almost touched the fair value gap. I'm gonna wait though. So let's get the daily. So daily. Hold on. I'm just gonna get in for now because I'm going to be taking notes. Oh, this is the new entry. The reason why I didn't wait is just because we were aiming for low hanging fruit at the start until we fully get grasp. So, entry. What? Nah. I'm being trolled. I need to fix the website. Let's just try. As in my money. Be careful. Oh. Daily. Good, it's lying now. Uh, that 1 hour. 15. Mm-hmm. Okay. Save the trades for now. have any rules right now. Let's start with the daily time frame. We decided a bullish candle stick. Now, why do we say this? Let me see. First thing, price. We have price come back down to the midpoint of equilibrium. Right here, price came to the level of equilibrium. That's one reason. We then have price took out sell-side liquidity, which I don't know why, but we had sell-side liquidity get taken here. We also see price take out previous high. Okay. And then I think that's the main thing, right? Push up, came back down to this equilibrium. This is a discount area. We had this candlestick take out this high, which is the previous day. And then we had this candlestick's low, take out this liquidity, this. Or to be fair, this one, because this one took out all of this. So we just took out this liquidity. And then couple that with the idea of price being at equilibrium. And that's everything from the daily. Let's save this. Okay. Can I make everything bold? Cannot. Okay, so that's the daily. Then we have the hourly. What do we notice on the hourly? Well, on the hourly, we can talk about the opens. So we had a run on sell side on equal lows during London session. In brackets, sell side liquidity. Okay, we also notice midnight open, initial to the downside. This makes me upwards. Okay, to 15. See a bullish fair value gap, which he drew. You see the red line, low hanging fruit, or the block. What else we see? We see price due to bias. We can say we are expanding. And then that's the main things. That's our first trade. And we will see it. So yeah, we actually finally utilizing the website. Like I said, from this day till next week, Friday, we will be just entering the markets, getting our feet wet. So, important to note, it's easy to unsplit them here. And yeah, our target's up here. It is a Friday, but we'll be targeting this liquidity by the end of the day, which will obviously signify our profits. So 1 to 2 right now because we got in a little bit early. I just had a feeling that price may not draw back deep into this just because of how much we've just been expanding upwards. Number one. Number two, I also noticed that based on our strategy, we're allowed to enter on the touch of the exterior here, or the touch of the upper bound. And then our stop loss, well, the difference was within a 1-to-1, but I'd rather be in the markets. That's just my strategy. So, and I was also going to be multitasking. That's another reason why I wanted to enter in early. But yeah, we'll see how this does. We'll say active trade for now. ADCAD I was looking at, what was my bias? I think my bias was bearish, I think. So I'm in that open over here. Then this is, this shouldn't open. Up. So I believe we're bearish, right? So we had this initial run up, push to the downside. Let's actually go to a higher time frame. So we had this initial run up, which could be the manipulation. We have displacement to the downside, showing that we could be bearish for the day. We're currently pulling back into this area. We then have, what do we have over here? We have an imbalance right here on hourly. We also then have order block over here. I'm going to draw it though. I don't like this. I think it's going to be indecision day. Nevertheless, we're just going to focus on the one we entered, the one where we actually have a goal on, which is buy sell liquidity up here. And of course, this is our entry as a continuation. Now, with this type of market, we can enter multiple, kind of like a compound, right? But the idea behind any compound we're taking would be in that it would have to retrace like this to a fair value gap, and then we aim for low hanging fruit. So our lows are extended, our entries are at the edge of the fair value gaps, and our target is the same. And of course, we need to have that risk reward ratio. So yeah, we're gonna let this go on the side, and then we'll see how that does, and we'll update it here, which is a new account. I didn't even know I had this account, so we'll just utilize this funds for now. If it does get blown, we'll just add more money. It's just, I like to trade, even if it's £10, £5. Obviously, £5 is a bit difficult, but even if it's £100, £50, £20, I like to trade on real money as opposed to demo accounts, just because I get, when I know it's my money, even if it's a small amount, I feel it more. I feel more losing £20 in a live account than I would 100,000 in a demo account. That's just me personally. Am I knocking demo accounts? Absolutely not. And I would still use, if I didn't have any cash, guess what I'll be using? It would be a demo account. So I'd actually use, and will still use, and will eventually use demo accounts. But I am using this for now just so I can learn quicker. So in the meantime, we're going to log off the charts completely. That's what I like to do for mentals. and then maybe at the end of the stream we'll see how far we've gotten into. I was trying to earlier bring this into the slides so it's all in one document, but it's hard to like copy a page over. See if I can do it here. Yeah, I think it's just manually doing it, but the other thing is it doesn't select the image. I think it's just a case of let me skip slide. Okay, wait, this is good. Let's get everything. Boom, 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 boom. There's been a way. Maybe I have to be all like this. Maybe. Oh, I just did the same thing again. There we go. Now. Kind of using this as my break, in case you haven't noticed. Another text box. I like having it separated. Something like this. So it goes 15 minutes. Okay, wait. This portion. Yep. And I have this portion here. Okay. Let's need that. That. Yep. Yep. Yeah, let's have this as one. Okay. Section here. And this is fine. Does this make sense? Then it's fine. Hey, this is gonna take long. We're doing page 5. Okay, we'll do one more, then we'll get back to work. This aside. Still start with this. That way. This. This. That goes. Image. Last one before the next episode. Oh Lord. image to the side. Right. There's going to be the big one at the top. What about it? Oof. Be interesting. We can do it. Okay, so it goes up to when? Let's try this first. This. And this image goes underneath that. This to the side of it. This to that. Then the rest below. Just do this. I don't like these ones. Put that to the corner. Clean. Doing episode 4 now. Keep that in mind. In the meantime, let's get back on track.
To occur with tools that make.
Okay, so currently he's talking about the relationship between DXY and S&P 500. I'm gonna make a note of it. Can get an image as well. So important to know. I need to fix a lot on the website. Give me a second to get a laptop. You're right. Yeah. So five. Number 4. Maximum 2 hours. I might even come up a little bit earlier just to do extra things. We'll see.
Makes sense. There's nothing ambiguous here. There's nothing, splattered across the chart. It's just simple, sound logic. Okay. I'm hopefully inspiring you to simplify, which many on the outside looking at what I do will make snide remarks like, oh, he overcomplicates things. And I'm not complicating anything. These are very simple ideas, and it helps you build the idea of bias. It gives you intermarket relationships and intermarket analysis to give you the trust. Okay. Why did I feel confident to publicly say that 9992 level?
But why rewound it?
Well, I explained that. Why did I think it was going to rally from there? Because I'm bullish on dollar. Why did I hint that we're going to be going lower into the E-mini S&P relative equal lows and as we enter into May? That's a seasonal tendency. So all those factors came together in my experience of almost 30 years, was used to hint at something for you to study. And if I'm right or if I'm wrong, you get to be a judge. Okay, you get to see and weigh me in the balances. I've laid it out there in your hands. You see right now in this chart what I was forecasting, the reasons why I was doing it, why I said what I said, and why it looks like it does in your chart today. All right, so here's that daily chart, and here's that bearish order block I was referring to. And the high I said is the level we don't look for it to be traded to, and you can see we didn't even get to it there. Okay, so we ran up into the order block, and then we had the weakness that was expected as we go into that May month, and we're reaching into these relative equal lows. That's the next draw. Level we don't look for it to be traded to, and you can see we didn't even get to it there. Okay, so we ran up into the order block, and then we had the weakness that was expected as we go into that May month, and we're reaching into these relative equal lows. That's the next draw on liquidity, but for now, again, just keep your study inside this order block that's taught in this YouTube channel. Okay, so while it's not a main factor in the model I'm teaching in the mentorship for YouTube here, I leaned on that as a basis for my analysis. Why I felt this was likely to go lower. That's the order block. That's the one that makes the likelihood of the market turning in this area and then going lower and attacking the sell side below here. Below the relative equal lows here is next, and then this low here. So ultimately, we're looking for a run below here for the sell side. Now, it might want to go down below here and give a little bit of retracement. If it leaves this portion open, that might want to rally from going over here up there. I don't think it would do that personally, but it could happen. But it's likely to draw into that old low here. Now, how we trade once we get there, that'll be interesting because I don't know if it's going to accelerate violently to the downside or if we're going to have a sharp retracement higher. I don't know that. Okay, I don't care to know that. Right now, I'm just looking for and submitting to the idea that we're going to keep drawing down on the daily chart. Each daily candle should be expanding lower and reaching into this area. Okay, that's what I'm expecting. That's my ideal scenario. Now, if you look at the daily range here today, we had a little bit of movement above the previous day. So we rallied above Monday's high and then failed and accelerated to the downside. Fell short of just running below these relative equal lows, but I still believe that's where we're likely to go. Had a little bit of consolidation in here, dropped, and we had a nice rally in here. Now, admittedly, listen closely, folks, because this is one of those times where I didn't get it right, and I have no problem telling you. I was expecting this to rally just a little bit higher and maybe flirt with that 43.20 level. I thought that we could get one more spike up into that, and then I was expecting to roll over and go lower. That did not happen. Okay, so let's go into a lower time frame, 15-minute time frame. And here's the midnight hour, New York time, and the opening price there. Notice we only had 1, 2 little moves above that, and that's a really anemic movement for what I was expecting, a little bit more pronounced rally higher. I wanted to see a little bit of Judas swing, about 20 handles, 15 handles to that effect like that, and then break down and create something like this. Okay, but we didn't get it. So some of you may be asking, and I believe it was Michelle in the comment section, mentioned that it didn't appear that Power 3 was in effect today. It actually was, but sometimes it's really, really small little movements like this, and it may not be useful to you. But what happens is when you enter the London session, which we do here, at 3 o'clock in the morning, it breaks down relative to New York local time. Okay, so 3 a.m. New York local time. There's a lot of folks in the comment section that are referring to and confused about daylight savings time and such. All of that is resolved if you simply just listen to the instruction I gave every single time I mentioned the time aspect. If you use this little area down here on TradingView and toggle it to New York, and all you do is by clicking it, a window will pop up, scroll to where it says New York, you highlight that one, click it, and then you're set. You don't have to worry about it. Don't worry about daylight savings time. Don't worry about anything. As long as you are aware of what local time is in New York, set a clock on your computer that always tracks the local time in New York, 24/7, 365 days a year. If you do that, you'll never have any confusion about what you should be doing relative to time. Okay. So if you have a small little movement like this, it can throw you off if you're expecting, like I was. I wanted to see a little bit higher rally. So in the morning, I was looking for maybe a little poke above here. Didn't happen. We broke down, retraced back in, bearish order block, and the imbalance, and spent a little bit of time here, and then rolled over right before the 9:30 opening. Okay, and I'm going to talk a little bit about the 8:30 and the 9:30, what times are useful, what are beneficial to your analysis, and what you should be concerned about. Okay, because there's a lot of questions about that. But ultimately, we moved into the lunch hour, had a little bit of retracement here, broke down once more, and then aggressive selling, really aggressive selling into the PM session, into the close of the day. If you look at the opening price at midnight local time, New York midnight local time, that's what this here is. That's that opening price. This price is useful for trading the London session. That's 2 o'clock and 5 o'clock in the morning, New York local time. And it helps me frame the Power 3 for the daily range. If I'm bearish, I'm looking for something to rally above that opening price in London. That's my ideal scenario. I'm looking for that personally. As you can see, we really didn't get much of that today. It was extremely heavy and just wilted and went lower. Sometimes that's going to happen, folks. And in this instance, I missed a setup. I don't get in what I'm thinking I'm expecting to see. So I'm human. You're human. You're going to look at something in the chart and you're going to have something that is your favorite model, whatever pattern is you're looking for. And it may not even be my stuff. Say you're just here casually watching. You're probably nodding your head saying, yeah, I've had lots of instances where I was looking for my particular setup and it didn't materialize and it went the other way without me. you're going to miss moves. You're going to misinterpret. You're going to read it wrong. That's going to happen. And that's why you have to use a stop loss. That's why you have to be controlled about how many times you go into the marketplace. And you also have to have some measure of flexibility. And that comes with experience. You're not going to always be able to see that this isn't going to go up for you initially. It's just going to just wilt and go the other direction. So when we get into the 8:30 hour, and I have the lines really light here because I want to be.
This is a bit too zoomed in. But he said a lot of good things, so let's slow this down.
And then aggressive selling, really aggressive selling into the PM session, into the close of the day. If you look at the opening price at midnight local time, New York midnight local time, that's what this here is. That's that opening price. This price is useful for trading the London session. That's 2 o'clock and 5 o'clock in the morning, New York local time. And it helps me frame the power 3 for the daily range. If I'm bearish, I'm looking for something to rally above that opening price in London. That's my ideal scenario. I'm looking for that personally. As you trading the London session, that's 2 o'clock and 5 o'clock in the morning, New York local time. And it helps me frame the power 3 for the daily range. If I'm bearish, I'm looking for something to rally above that opening price in London. That's my ideal scenario. I'm looking for that personally. As you can see, we really didn't get much of that today. It was extremely heavy and just wilted and went lower. Sometimes that's going to happen, folks. And in this instance, I missed a setup. I don't get in what I'm thinking I'm expecting to see. So I'm human. You're human. You're going to look at something in the chart and you're going to have something that is your favorite model, whatever pattern is you're looking for. And it may not even be my stuff. Say you're just here casually watching. You're probably nodding your head saying, yeah, I've had lots of instances where I was looking for my particular setup and it didn't materialize and it went the other way without me. You're going to miss moves. You're going to misinterpret it. You're going to read it wrong. And that's going to happen. That's why you have to use a stop loss. That's why you have to be controlled about how many times you go into the marketplace. And you also have to have some measure of flexibility. And that comes with experience. You're not going to always be able to see that this isn't going to go up for you initially. It's just going to just wilt and go the other direction. So when we get into the 8:30 hour, and I have the lines really light here because I want to be able to show where the highs and the lows were on the respective candles. So this is the 8:30 and this is the 12 a.m. midnight candle at New York. So this is New York and this is midnight New York. So there's a distinction here. The beginning of the day, this is where I look for the daily range power 3 setup and or the ideal scenario. If I'm bearish, I want to see something rally above that opening price. If I'm bullish, I want to see it decline below that opening price. Okay, that's pretty much the basis for the opening price at midnight. It may not be a factor for you like it is here. It's not much of a use, for anything except for, well, here it opened and it just basically went lower from there. At 8:30, the same thing. I look for those types of scenarios. I'm looking for weaker prices. I'm looking for it to trade lower. And does it rally above the 8:30 opening price? It never does. It's too heavy. It just wilts. Okay, it keeps going lower. Now, the opening price at 8:30, I use that for, again, power 3 for the New York session. The same thought process that I'm using for the opening price at midnight in New York time. That opening price, if I'm bearish, I want to see a move above that. So I dub a Judas swing, a false rally, or a suspect rally. I usually like to fade those types of moves. As it goes up, I sell right into it. And it's scary for someone who doesn't understand what you're looking at. But if you know what you're looking for, and it takes a lot of experience and learning and back testing and seeing things, you'll be able to do those types of things over time. But that same element of trying to look for a short above that opening price in New York when I'm bearish, I would expect the same thing to happen for the New York session, a rally above that opening price at 8:30, and then decline. So I'm looking for something to rally above that and fade it, but it isn't doing it today. So now look what's occurring here. This is really important that you understand this part of it. You know that I've been bearish. I've made it public knowledge here. Did we rally above the opening price at midnight? No. Did we rally above the opening price at 8:30? No. And we're bearish. What does that indicate to you? Obviously, with the benefit of hindsight, it's extremely bearish. It can't even rally to a short-term premium above the opening price at key levels and time. So we have an extremely heavy bearish market. So it's not going to give us these stunning little short-term rallies that we can fade. It's just going to stay heavy, and either you get in where you can find small little pockets of imbalance, or you miss the move entirely. Now, as it
Good nuggets there.
It happens today. My wife went on a trip. I had to take her to the airport. I was only able to capture $2,000 worth of movement in the S&P E-mini. That's the only thing I could capture. When I got back, I didn't participate in the afternoon, and looking at it now, I missed a really, really huge opportunity. There was no trading whatsoever in the afternoon. My money was made short on E-mini S&P in the morning session, and that's all I had for today. If I would have just held on to what I had in the morning, I could have done around $12,000 today alone. But I didn't hold on to it. I had other things to take care of, and that's the reality of things. Real life creeps in. It's going to happen. But for those of you that are trying to learn these concepts, these types of movements are going to be very frustrating in the early stages of your development, because you're going to feel like they're changing something. They're aware of this. This stuff goes on a lot. It happens in the futures markets, like commodities like corn, soybeans, gold, oil, stocks. Sometimes the markets are just simply too heavy, and they're not going to rally for you, okay, to short into it. It doesn't mean that they've changed anything. It doesn't mean that the concepts don't work. It just means that this is a market that is extremely bearish. And when it's extremely bearish, you have to trade it differently. And I'll show you what I mean by that here. And I'm not trying to inspire much outside of the mentorship, but I know some of you have asked this in the comment section. Plus, it helps my own personal group to understand this as well. So it'll be a little bit of a refresher for them. All right, so here's the London Open setup. This was the move that set up the only real sound entry, in my opinion, that took place today. Here, this displacement, fair value gap, rallies up, bearish order block, fair value gap, runs into it, and then you hold it. Because of the market structure, shift below the short-term low, the imbalance, we went back up in. This imbalance here, remember when I taught you about this? This one here can be traded to on a spike. You can get up in there, but your entry is on the lower fair value gap. You see the logic working here? You are going to use a stop that's going to allow for the market trading up into this one. So you may not like that much risk. You may not be able to take this trade. That's all part of this game. But you can trade a micro, or maybe you could. I shouldn't say that you can. I don't know what all of your risk parameters are, what you can work with in terms of margin. But while you're learning in paper trading, obviously, you can use anything because it's all hypothetical money, and you're learning the skill set. But the rules are still sticking to what I gave you in terms of the logic. If you have two fair value gaps, you're using this as the entry, and you're using this as the risk. Don't always assume that you can get up here and get the best entry, because it never went there. See that? So it's things like this. This is what I refer to as a signature in price action. These are algorithmic things that repeat, but you have to have the discernment and experience to know when it's likely to occur, when it isn't likely to occur. So anyway, let's talk a little bit about the 8:30 time period and 9:30. All right, so here's 8:30. Got the imbalance here after 8:30. Now, normally with the model, I'm teaching you to look for something to the left prior to 8:30, some kind of short-term high. We want to see it rally up. And using the opening price at 8:30, which is here, we want to see it rally above that, run some stops, then break down and create this type of scenario where it has displacement and an imbalance. It rallies back up into the imbalance and sells off. The model doesn't exist in today's price action on the 5-minute chart. It doesn't give it to you there. Okay, so I'm going to give you coaching, if you will, to kind of like show you what was in price and some of the things I was looking at to help get in sync with the move, but I didn't ride the whole thing out. Okay, and believe me, I'm looking at this today, wishing I just would have had at least one of the two contracts I had on still, and just let it run. I could have done, about $8 grand or so. But I didn't do it. Okay, I was leaving. I was taking my wife to the airport, and it's just better if you're not going to be in front of the charts. And anything can happen. You have to get delayed out there. The phone doesn't connect with the broker. It's just better just to be away. If you're not going to be paying attention to the marketplace, just simply completely close the entire position. Also, I'll throw this in here too. Or shortly before I started doing the recording here, I saw a question: do I ever hold overnight in these current conditions? I stopped holding overnight like 24 hours years ago. We had a lot of things going on in the world that changed my trust. Just like I used to hold things over the weekend and expect continuation going into the opening on Sunday and Monday, I no longer hold over the weekend. So I am 100% in a session or a day and out before the close. Like I'm not holding 24 hours. I'm not holding 12 hours. I'm not doing those types of positions. Typically my trade is anywhere between 90 minutes to 2 hours maximum. That's about the length of time that I'm holding. And I'm looking to take mine and get out and then reassess things, because there's just too much risk right now in the marketplace, all asset classes. And things are now starting to get a little wild, and it could get a little bit more wilder. Okay. But the 5-minute chart has the imbalance in here. We saw that run. And the model, I want to see it run above the opening price at 8:30. The opening price at 8:30 is the New York sessions opening price. Now, don't get confused with the New York midnight candles opening price, because the New York Association in the name, New York session is the 8:30 to 11 time period, New York local time. So I'm looking for this framework to offer Power 3, which is a fractal element of accumulation, manipulation, and distribution. That's what Power 3, the three things that is empowering you is understanding those three elements. Accumulation, what's accumulating? Short positions, okay? Why? Because it's bearish. So smart money would accumulate short positions, then anticipate manipulation above the opening price. They would assume more short positions there. Then it starts to go the other direction, and they distribute their short positions at some important low that we're able to forecast. And obviously it's relative to those daily equal lows and old daily lows and projections with the fib. All those ideas come to mind in concert with, in agreement as well, with time of day. Okay, so we're looking at a movement down into around the lunch hour beginning at noon. Okay, it creates the important low there, and then a retracement during the lunch hour. One more time, it punches above the high here, then it breaks down, consolidates, starts to create 1, 2, 3, and then you can expect continuation going into the afternoon session. We're not going to talk about the afternoon session because honestly, I wasn't participating in it, and it is what it is. I'm familiar with this morning because I had some horses in the race today. Okay, so we'll start getting a little bit more detail here. Here we have the 4-minute chart. The imbalance here. This is one again that is not rallying above the opening price at 8:30. Now it's showing 8:28, but that's because I'm showing a 4-minute chart. So don't let that confuse you.
It was very interesting. We kind of have this idea in my trade I took for EU. The fact that, well, we already have this midnight rally to take out these sell side liquidities down here. And we could have potentially gotten some entries over here during London session, but we weren't looking at the charts. Then from the, this is 6:30, this is the wrong place. 8:30 right here. From this market session open, we then have a small pullback into the Fair Valley gap. Our entry was originally at this red line, but we got in earlier just because of the multitasking, etc. And that could be part of the Judas swing. So essentially, what's interesting is that this is actually helping us now because we even noted that the same power 3 we look for at 8:30 a.m. That's the first time I've read it, and that's instinctively what I've done without me even realizing that this small push downwards could be almost potentially classified as a Judas swing, depending on what price does. We had this pullback into this imbalance, set a stop loss below the first candlestick contributing towards this Fair Valley gap, which is this candlestick here. It's fairly tight, and then we're obviously targeting the buy side liquidity up here. So in theory, we should have 1 and 2. We should have 2 entries. But we just take the 1, that's fine. Excuse me, until we fine-tune the London session. I think that's what we're going to have to be doing now. I mean, market open or midnight open, that power 3 can still technically be attributed to London sessions entries. And then the New York open may be continuations / maybe even reversals, we'll see. But I need to know, I want to do more in knowledge. I want more knowledge in terms of the London session, so that I will be able to determine whether or not I am able to trade both with the same model in the same way. Okay, so we had that rally we bought already. We were targeting here. Obviously, being Friday, the volatility volume may not be that much. So with this, it's essentially, I don't want to write this down too much because, again, we kind of talked about what is happening already. We have the new midnight open. We don't really rally up above these sell stops, which was what we would like, but we don't. We get a displacement, retracement into that, and then we can have a sell-off. We would have rather price gone up to then, after displace downwards, have a retracement. So we want this move to happen after sell stops get taken, but we don't get that. Like I said, that's somehow very interesting because this is pretty much what we've had here. 8:30, we don't take out these stops. We just pull back into this. Well, midnight, sorry. To be fair, we do kind of take it out a little bit. But then again, he mentioned that we do take it out a little bit over here in the previous, over here. He said it, previous 15-minute time frame. We take out some stops over here with that wick. So, yeah. So that is the shape we're looking for. Or Fair Valley balance. The Fair Valley gap. We then have that displacement, retracement back into it, and then we have the sell-off. And when you have a bearish market like this, because it's 8:30, so that wick, sorry, I was referring to was at midnight over there. But we would still like that same thing to happen over here, which is over here. I don't know if he mentioned that actually. Yeah, this market opening, we don't really have a wick above, so that's my mistake. I was referring to the wrong thing. I was referring to midnight open. So yeah, when it's bearish like this, remember we have a bearish bias. So it's not like we're just bearish from the day. Because if we were to not have a daily, we don't know what's happening in the daily time frame, this is not a good to sell because we won't know if this is maybe part of the Judas swing or if this is just the actual move. But you know that once you understand the bias. So yeah, I mean, he's basically saying the same thing here, which we've kind of put that we need a measure of flexibility and understanding that because we're human, we're not always able to catch the moves. We may receive them, but we're not always going to get what we want. And I need to kind of, Maybe should mark it. Yeah, I think we keep it as is because when you combine these two paragraphs, it basically sums up what he's saying here.
But the opening price, again, never got traded above at the 8:30 candle. So whatever that opening price is at 8:30, you extend that out in time, and you want to see that rally above. Now, when you have this expectation, the other aspect of time is the 9:30 opening. That's when the equity market or stocks themselves start trading their New York session. So what?
Give me a second. I want to. Okay. So hot. This website is down. Great. Okay, so we back.
Had some horses in the race today. Okay, so we'll start getting a little bit more detail here. Here we have the 4-minute chart. The imbalance here, this is one, again, that is not rallying above the opening price at 830. Now it's showing 828, but that's because I'm showing a 4-minute chart, so don't let that confuse you. But the opening price, again, never got traded above at the 830 candle. So whatever that opening price is, 830, you extend that out in time, and you want to see that rally above. Now, when you have this expectation, the other aspect of time is the 930 opening. That's when the equity market or stocks themselves start trading their New York session. So what happens at 930? What am I expecting at 930? Well, number one, 930 is just when the opening occurs and there's initial volatility. Now, it could be whipsaw, where it can go up and down real short term and go both directions in a small range. Sometimes it could be a really large range and clear both sides of the buy and sell. And then whatever the real news is going to be for the day, we wait for that to unfold. Today, we can see at 930, it just starts to run lower. It doesn't give us a rally at all. So it just starts to speed up what's already in motion from 3 o'clock in the morning during the London open session. So at 930, all it does is start to accelerate down. Okay, and the same idea is being shown on the 3-minute chart. You can see here that middle imbalance is a little bit more refined, trades up into it rather handsomely, breaks down, and here's another. Here I got with a bearish order block. Now this is one here where it's useful because you have a little bit more insight as to what it's doing. It's too heavy. It's not likely to rally. There's no reason to look to go long. Start looking for reasons to get short. And anytime you get an imbalance and we're above those relative equal lows on the daily chart, because it's going to draw down into that. That's the heaviness objective. Okay, why the prices keep going lower, 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 lower is because they're gravitating towards those relative equal lows on the daily chart. Okay, so go back to the chart where I mentioned in this video and show the daily chart. I have that little blue line. That's where price is being drawn to. Okay, the algorithm is marching every minute, every hour, every day to that level. How long does it take to get there? I don't know that. But I mentioned in my group that I didn't want to see it happen like we're seeing it right now, because it's too fast and it doesn't give it a lot of opportunities to get in with it and ride it. So you either have to have entries like this, which unfortunately isn't scalable with the model I've shared publicly, but I do have obviously opportunities to go over it like this and show you how you can still use the idea of the fair value gap to get in with it, but you're going to have to leave out the element of a rally above the opening price at 830. And 930 just creates a lot of volatility. Okay, the initial surge in the New York session as these stocks begin to trade it, basically. So as a recap here before I go into the next slide, midnight New York time, that opening price, I use that to trade the London open session. That's 2 o'clock to 5 o'clock in the morning. And also to help frame the idea, like say I sleep through London, which is 90% of the time what I do today. Like I don't do a lot of London session trading. And because of that, when I wake up and I'm looking at the market around 7 o'clock in the morning or so, I'm looking at what has happened overnight. And did we create a scenario that I would be looking to trade if I was awake during London? If it happens, then I know that I'm really built in with an advantage on the daily bias, because if I'm bearish and it creates a rally above the opening price, midnight time New York, and it creates that rally, that little Judas swing I explained many times already, and it starts to decline and I'm below that around 7 o'clock in the morning, I know that I'm likely to create a little short-term rally, but it would be ideally above the opening price at 830. But it may not do that. And the price just remained heavy below both opening prices at midnight New York local time and 830 New York local time. So everything was extremely bearish, and it was just so heavy it could not mount any meaningful rallies. Many times in my early development, I got crushed on days like this, where it felt like, okay, it's too low now. It can't just keep going lower, so I'm going to try to buy it now. Because indicators told me they were oversold. 1992, 1993, 1994, I blew account after account after account doing that. And it's frustrating. Now, obviously, with 3 decades of experience behind me, I know what it's trying to do and where it's trying to get to, and it's getting there in a really fast rate of speed. Now, obviously, you can get there a lot faster than that, but I don't want to do that because it gives no real opportunity for me to engage and participate in. And it doesn't give you, as the student, to engage also with your demo or paper trading account to practice. But as real life sometimes is, it's unfair. Okay, it doesn't give us what we want. Sometimes our expectations and our wants are denied. And in today's climate, that is not popular. And that's why this market and trading these markets is very, very difficult, especially for like the millennials. Okay, that ideal, perfect, always come exactly as I expected, sometimes it's denied. And either you accept that and navigate the markets with imperfection and without the ideal scenario for your model, or you're comfortable with just letting go and not doing anything and being accepting when it comes to big moves and you can't participate in it. There's lots of moves, folks, over the last 30 years that I missed that were huge, big, huge moves. For instance, Bitcoin. I called that thing. I called that thing at 7,500 to 20,000. And then right before 20,000, I said it wasn't going to 20,000. It was 19,700. And I said it's going to go to 6,000. And everybody laughed and went down. And I said it's going to go to 3,000, but it went down to like 32. And then I think a couple times I had it wrong publicly. And then I said that we would go to 20,000 by Christmas. I think it was 2020. And I said 30,000 by New Year's, and I was off by about 18 hours. It went to 30,000 on the 2nd, I believe it was, on January 2021. And then I said 55,000 and 66,000. That was about as far as I could see it go. And we went just a little bit above 66,000 and hasn't been doing much since. But I didn't do anything with that with real money. So I missed a huge run in something that would have otherwise paid out a lot of money. And I've missed a lot of moves in the futures markets and a lot of commodities. I missed a lot of stock moves, while I was teaching Forex. There's a lot of stock movement in index futures that I didn't participate in. Guess what? It's okay. I'm able to still find trades. I'm not starving. And that's the reality. You're going to have to come to terms and to grip with you have no way of participating in every single move. And don't think that you can find every big move. You're not going to participate in every single price swing. You're not going to, folks. I miss moves. You're going to miss moves. And it's okay. It's part of this game. This business is going to still run and do the same things we're looking for all the time. And you're not going to participate in every move. Okay? So give yourself the permission, okay, to be human. You're going to do it wrong sometimes. You're going to see it for something it's not. And you're going to miss that big move. I had a little piece of this today, but I didn't get the whole thing. I wish I would have, but I didn't. And it's okay. I forgive myself for being a good husband, taking my wife to the airport. I know this is all too much stuff and you don't care. Some of you like to say those things in the comments. Get to the point. The point is, you do this, you're going to have these elements creep in. And how are you going to deal with it? You're going to get mad and go on social media and blurt out and curse and say, these markets suck. No, that's not what you should be doing. You should just reason with yourself ahead of time. Say, okay, I'm not going to be able to do everything. I'm not going to participate in every single move. And this is what happens sometimes. It doesn't mean the model's broken. I promise you, over the next couple of weeks, you're going to see the model delivering like it's done in the past. And it's fine. There's going to be times when the market shifts in and out, and the market structure is just too overwhelmingly bullish or too overwhelmingly bearish. In this instance, the bearishness I gave you guys just was a lot more bearish than the model would permit for entry. But you can see there's fair value gaps in here you can use to participate. Dropping down to the 2-minute chart, and see again, we find in real nice here, and then once more in here, and then drop down to that noon time, creating an important low, which is what I taught you in this mentorship already. And that 2-minute imbalance you can see on the 1-minute chart here and here. Real nice delivery there. And these are just simple little imbalances to get in sync with what is already in motion, not needing to see it rally above the 8:30 opening price because it's not likely to. So it takes a little bit of courage to get in here and trade these types of setups. But that's what you do. Or you don't do anything and you just tape read. You watch it when it does it and say, okay, I would like to see it drop here. And does it drop? Yes. And you study that. And it gives you another fair value gap in here that's not highlighted and it rallies up to a fair short block and sells off. And your stop is above here. And just because it goes down lower doesn't mean jam your stop loss to here, because that's what happens. You need to have time and price behind you before you start moving your stop loss. And also any trades obviously lower into that noon time. All right, so I think that's going to be it. The next episode on Thursday, I'm going to show you a couple things inside the trading platform on TradingView that I think are useful. It answers a few things, and one of the students made mention that could I literally go in and show how to set up the Fibonacci. So I thought it was kind of simple already, but obviously some of you are really, really new and you're not familiar with the TradingView platform. So I'm going to add that at the end of the video on Thursday coming up. Okay, so that way it's at the end, and anybody that already knows how to deal with it, they don't have to go through and watch all that stuff. But I'll give you another teaching and lesson, obviously, on Thursday. And until I talk to you then, be safe.
Next.
Do go right back up into what? If everybody got end.
Right. We have news. We lost the first trade. The new ARK. I don't know if this is unfortunate or if this is a bad trade. I don't know yet. I need to see more, then I'll know. Because are we bearish? Both we're bearish. I don't think we should be, right? No imbalances. I can't classify that as an order block. DXY, let's have a look. I'm sure we can find a better one. Let's go capital.com maybe. Oh, can't actually we call this being bearish a while back. Yeah, I'm just bearish. Back to order. Right. So first things first. Bam. I'm gonna keep it and then we'll see what happens. Because what could happen is the price now delivers to this target, and then it becomes okay. We just got in wrong. We misread price. Because technically, we over here in London session we had the sweep of the sell side liquidity, then we displaced. Here we didn't wait for any Judas swing, so to speak. So from that session open to around about 9:30, price to come to our entry level, we could have had a deeper stop loss, number one, which could mean that maybe price ends up going up. That's one idea. Another idea is that we got the bias wrong. So maybe we're targeting this sell side over here, and this whole thing is a Judas run. That's plausible or possible. And then we need to see why it's bearish. Then another idea, okay, let's say it's bullish, but it just wants to come down. It's liquidity. Here we had a run on the sell side. We could be having a run on the sell side here as well, where we are targeting these lows first before we go up. Potentially. I doubt it because it's only a liquidity in the 5-minute time frame, but it's possible. So yeah, we'll just see. I just thought it would be very bearish because it wasn't much bullish, sorry, because it wasn't much. It was a very quick move, very strong displacement. We had the fair value gap, the continuations idea and whatnot. So we'll see what happens. That's why I'm not trying to say what the issue, if it's the bias, if it's the entry, we'll see over time. That's our first trade as a loss. And we will mark that in because we obviously mark our losses as well as the wins. The time is currently 3 o'clock. How long is this episode? It's an hour, right? I think I might call it here, you know. I might do this off stream low key tonight instead of on stream. Yeah, I'm gonna call it here for now. I will potentially might after episode 3. I mean, 22 can go to 23. I think we could potentially be on episode 25 by tomorrow. We'll see. We'll see. It's only 3 o'clock. Okay. I do have quite a few things to do off stream, so I'll get put in the work, and then I will from there keep you guys updated. Remember, Telegram's where we're at. We will be updating this as we go along. It was CJ and I will see you guys tomorrow. Peace. Day 63 done.